name is Nick Crowder. I'm the CEO of City and State Real Estate here in Oregon and Washington. I'm also a CCIM, which means I'm a total real estate nerd. And we have a really great class today on something a lot of folks aren't aware. That's been around for quite a while, called a Delaware Statutory Trust. And so to help present this, we brought in some experts. John Bacigalupi from Cantor Fitzgerald, David Moore from Equity Advantage 1031, and Bob Zink, who is a longtime real estate pro and good friend. Jordan Fezler, also our head commercial broker for City and State, is going to give you a quick update on what's going on right now in the commercial real estate world and in the Portland market area. And so I'm going to hand this over to Jordan. If you want to start sharing your screen, we can talk about the market. And we are going to have time for Q&A at the end. So if you have questions, you can use the chat feature, and we'll try to go through all of those at the end here when we're done presenting. And we are recording this, so if you came in late, we'll be able to send you a copy of it. You can share with friends, and contact information for everyone who's on the call today. So thanks for joining us, and I'll hand this over to Jordan.
All right, thanks, Nick. My name is Jordan Fez. I'm a commercial broker here at City and State. Just going to give you guys a quick rundown of the four main sectors of the commercial market, which has certainly had some changes with the whole COVID pandemic. Some sectors have been hit much harder than others, but some are doing actually really well currently. So to start with the multifamily market, there's certainly been some uncertainty. There's been payment deferrals for the tenants in multifamily, but everything's showing that payments have been up to 94%, which is actually very close to or even better than some of the pre-COVID numbers. So the tenants have been paying their rents. So that's a good thing. Buyers and the lenders have become significantly more conservative, and any properties that have been under contract currently, there's been a lot of retrading. We're seeing any numbers between 5 and 10% on on a contracted price. Lending requirements in the multifamily market has become significantly more conservative. The main thing is principal and interest reserves. Some lenders are requiring 6 months at a minimum of principal and interest reserves, or up to 12 months of interest-only reserves. So buyers are often having to bring more money to the table to close. So that's making some transactions significantly harder. There's good news though, is that the lenders are being highly competitive. Credit unions, especially, you can get some very, very cheap money, interest only, even as low as 3.5% of interest only. So there's some really good options out there. And here in the Oregon market, we're seeing most of the buyers are coming from out of state. So I think it was around 60% of the multifamily buyers were from out of state. And we'll probably continue to see that trend as the California multifamily market are having even tougher landlord-tenant laws than they did previously, and they were known as one of the toughest for landlords. Over the last 12 months, there's been $2.1 billion in sales. The average cap rate is still around 5%. We're still seeing that. You may see it tick up a little bit, but if you're a multifamily owner right now, you can consider, anywhere between 5 and 5.5% on a trade of your asset. So still really good for the multifamily market. Moving on to the industrial market, it's one of the strongest sectors in Portland and in Oregon. Q1 of 2020 had its highest sales in over a decade. It's a really tight market. There's not a lot of availability. There's a lot of national tenants that have come in here to Portland, including a brand new facility that's being built right off the I-5 corridor by Prologis, which is bringing in some of the largest national tenants in the country. Cap rates there are a little bit higher. They're at 6%, and demand for owner user is very, very high. It's competitive. So any industrial property owners have really reaped the rewards in the current market. Over the last year, close to $2 billion in sales. Cap rate's been close to 6%, and you're seeing multiple offers on a lot of these industrial properties. Office, that's one of the big question marks that we have right now. Valuations remain sensitive to investor sentiment, and sellers may find that buyer uncertainty impacts underwriting assumptions, bids, and negotiations. We just don't know what's going to happen with the office sector, if people are going to get back to work. Are employers going to need more space so they can provide spacing to make their employees feel safe, or are they going to have less space because they found that they've had pretty good production with their employees working from home? It's certainly a big question mark on what it's going to look like in 6 months from now. Lenders have definitely become much more conservative with these assets. Though Nick is currently in contract to buy an office property, and he's got some pretty good offers from some credit unions. So anyone that's looking to buy another property, we'd certainly encourage them to shop around for some really good rates, because they're certainly out there. Cap rates in office has been around 6%. There's been a little over $1 billion in sales in the last 12 months. And right now you're not seeing a lot of office properties being sold. So time will tell on how that sector does. And then lastly, the retail sector. This is probably the most sensitive market right now. There's a lot of small business owners that lease out their retail space. They typically have around 2 weeks of reserves. Restaurants have about 10 days of reserves, and we're likely going to be seeing a lot of restaurants being shut down. They just can't afford to pay their leases. So that's significantly impacting the retail sector. And it's pretty tough to get some lender approval on those. And we're likely going to see this sector have the biggest negative impact over the next probably year or so. As you can see, the sales volume for these assets is much, much lower than the rest of the sectors in Portland. A little bit higher of a cap rate. So if you are more of a risky buyer, you can certainly purchase a property anywhere between like 6.5 and 7 on a cap rate basis here in Portland, but that does come with its inherent risk of tenants not being able to pay their leases. Not to say that there's not a lot of properties being traded in the retail sector. It's just much more scrutinized, and you want to take a really good look at those properties. And if you are a property owner, you want to make sure that you're getting your tenants to pay in full, or work with them to make sure that they're on a plan to make their payments. So that basically wraps up all the sectors. I do have a full market analysis on each one. I'm happy to send whomever would like to read through all the data that I put together on each sector and learn more about it, including markets outside of Portland. So please don't hesitate and ask if you'd like to receive that. So I think that's it for me, Nick.
Excellent. All right. Great job, man. That's really good information. That was a great report, and hopefully everyone out there has learned a little bit more about what's going on. I think the big picture is that there's still quite a bit of activity. People are still buying and selling. And there's definitely, it's not business as usual, but we're able to get stuff done. It just takes a little bit more work on the lending side and a little creativity. All right, I think we're ready now for John to take over the presentation, and with David to talk about 1031s and DST. The idea here is that, building buildings are still selling in Portland. There's still a lot of buyer activity. 1031 exchange allows you to sell a property and defer your capital gains into a new asset. And a DST is a way to get out of the property management business and still be in real estate and still be able to use a 1031. And that's what we wanted everyone to learn more about today. So John, thank you for joining us.
Thank you very much. Appreciate the opportunity to speak with you. David, why don't I bring up the deck, and I can share a few slides, but you want to get started on just kind of the overall activity at the QIs with the extension of the 45 days to identify through July 15th?
We're about actually at the end of that, and I probably, John, if you've got, does your deck contain a slide talking about that or not?
This is a CE presentation that I'm bringing up, so unfortunately it doesn't. It's just kind of the basics of 1031 exchange.
All right, so you know, really the stuff we're working on now, basically it's washing out. We in the industry are looking for additional extensions, but as far as anybody going into a transaction right now, they're not really getting any relief. And for the people out there, as far as extensions in 1031, historically we'd never had an extension for anything pre 9/11. Since 9/11, anytime we've got a presidentially declared national disaster, we've been issued extensions. Typically, they're geographically, restricted to the event, whether it's a flood or tornado or whatever it might be. This is the first time we've actually had a national extension there, but it's just kicked things out to the end of July, and obviously we're rapidly approaching that. So people we've got a select window, and the reason I asked whether you had that, John, is I've got a slide that what I'll do is I'll get it out to everybody so you've got it to look at. I've got 3 pages with examples. One covers the dates of application, what's going on. So instead of taking a bunch of time on that, because it does get sort of screwy and it's very limited with respect to who's getting any relief. And honestly, like I said, anybody that's closing anything now, they're not going to have any relief unless somebody comes up with an additional extension coming in. So I'll get that out to everybody, make the slides available with the follow-up on that. I think in respect to COVID and what we're seeing, the biggest issues we've got, and Jordan, you did a nice job of talking about, is that the impounds that are required for the lending. And I guess what I'd like to say is, when we look at the DST stuff, I mean, the bottom line is if you don't give people a place to go, they're not going to move. So if you're an investor and you're just asking somebody for something, I think right now we've got so many people. I've got so many clients, honestly, that are just done with the whole West Coast, period. And and yesterday it was interesting because I've been talking to our clients day in, day out for at least a month now about the whole thing we've got in Seattle and Portland, where these politicians are telling the tenants they don't have to pay. Meanwhile, the owner's getting tanked. And what I want to put out there to people is understand, even in a short sale or foreclosure, for those of you that were not involved with the last crash, in short sales and foreclosures, it's still possible to lose the entire asset and pay tax for the privilege of doing that. And it's something called phantom gain. So you look at gain in a disposition in a short sale or foreclosure, you're looking at whatever's greater in a short sale. You look at the sales price of that thing, but whatever's greater, the debt or the sales price is going to be treated as a sales price. And when we go into these transactions, these situations, we've got lots of people that are looking for a place to go, and another benefit of that DST for the place to go is, as far as their ability to go out and get finance to make those acquisitions happen, is very attractive for people, obviously. But I just look at it that way, that the impounds, at 6 months to a year impound that was mentioned by Jordan is just devastating to people. You think about buying larger properties and your ability to impound a year's worth of principal. I mean, that's just crazy. And where's the natural place for people to do it? The 1031 funds. And if they take the 1031 funds for the impound, that's tax, that's boot received. So it's something, that's the biggest issue we're facing right now, is just how to get through the financing going forward. And that's one of the things, with John, his product, you don't have that issue. So that's a wonderful, wonderful component. But where we're seeing issues, people are just, it's a flight from the craziness. I mean, people have just lost their ability to control the assets, or even financially take care of the assets in some cases, and they're wanting out. and needing to go out. And it's just really important if you're in one of those situations, you got to understand first and foremost what your gain is on a disposition. And the exchange is a simple process. You're just going to sell something, buy something, and we're going to turn it into an exchange, right? So when we're looking at that DST stuff, I look at it as basically an exchangeable REIT for all practical purposes, but without, REIT, you don't get the benefits of ownership. When John's going to explain, well, with a DST you do. So that's why I like them. And we actually even have, for those of you on the call that don't know me, I've got two companies. Equity Advantage handles tax deferred exchanges, just 1031exchange.com, and then IRA Advantage that handles retirement accounts for people that want to diversify outside of Wall Street's holdings. And in times like we're in right now, we actually do a lot of business startups, and we actually combine qualified money, that IRA 401k money, with 1031 money in transactions. And we might even have people with IRAs and 401ks buy into the Cantor Fitzgerald type assets. And you might say, well, gee, why am I do that? I'll just go buy a REIT. Well, like I said, that REIT doesn't give you the benefits and burdens of ownership of that real estate component where the DST does, and that's why people want to do it even with qualified money. And it's really interesting to me. I was presenting, I don't know, a few weeks ago, and a financial advisor said, well, you can't buy a DST with an IRA or 401k plan, and there's nothing further from the truth. You can obviously do that stuff, and there's many reasons to do it. But with respect to the exchange, where we're seeing the issue is just the financing. You better not be giving stuff up until you know you're going to be able to go buy what you want to buy, understand what your tax liability is, talk to your lender, get pre-qualified, make sure that you understand where you're going with this stuff if you're not buying into something like Cantor's got. So, as far as the exchange, I'm going to turn it over to John, but I'm just going to get real quick. The way I look at an exchange, 4 basic issues: keep it simple, stupid, right? So it's got to be an exchange. You're going to give us something, we're going to give you something back. The boys at City State are going to be selling stuff, finding the stuff, and this way they don't have much hunt. You got John here with this stuff, and Bob, but that takes care of that component. Biggest issue with any exchange is product. It's finding what you want. It's having those things happen in a timely manner, and this is a great place for people to go. You need to go across or up in value and equity in these exchanges. And what I want to say is, John once again is going to talk about the product and talk about probably LTVs and this stuff. And if the LTV loan to value doesn't quite match what you gave up, understand, and this is one of the biggest fallacies in the exchange world. People always say you got to replace debt in an exchange, and that's totally incorrect. Debt can go away 2 ways. One, by going down in value, triggers tax because you went down in value. The other way debt goes away is by adding cash. So you can always add cash to a transaction. I've got lots of people in times like we're in right now saying, hey, I've given up this property of debt, of this, and I know I've got to replace the debt, but I don't want debt. So maybe I need to pay off the property and giving up before I dispose of it, relinquish it. That way I won't have to have debt going forward. And that's totally unnecessary. You don't have to do that. So when you're looking at that third of the 4 components I'm talking about, value and equity is what needs to be done. And in times like this, we've got lots of people that maybe want to pull money out. And you got to understand, the only time you can get money out of an exchange, number one, it's not all or nothing, but you're only going to get money out at settlement or after you've purchased everything you have the right to buy. So when we get to that 45th day, you're totally committed either to complete the exchange, you're identifying things and you've got to get it done, or you're going to pull the plug. Because what happens if we get to the 45th day, you identify 2 or 3 properties just in case, and now you say, Joe, I don't really want it, and maybe Nick finds this other property that's perfect, or Bob and John have a great offering you want to change your mind on. Well, if you didn't identify it on the 45th day, you're stuck. And then what's worse is I can't give you your money back until the 181st day. So, anybody on the call that understands what an OZ, an opportunity zone is, you got a 180-day timeline with that stuff too. So don't look at that as a fallback. You've got to really be committed to that 45th day. I'm going to complete this exchange, or I want the money. And that's where I'm having the biggest push with our clients, is to make everybody understand and put things in perspective. If we go back, let's say 15 years, 20 years, if somebody wanted to terminate an exchange because they changed their mind, I'd just say, hey, okay, here's your money, go pay the tax. But we cannot do that. Any exchange company that just gives money at will has got invalidated exchange. It's not just going to invalidate your exchange, it invalidates their entire procedure and nullifies that company as far as giving valid exchange transactions. So you don't want to work with anyone that's just going to give money out. It's got to be in there. And the rules for holding and disbursement of funds is what's called the 1031G6 rules. And, if anyone's got questions out there, reach out to me. I'll get you a page on, access to funds, when you can get it. But what I'm telling you today is really understand, my advice is before you ever sell something, understand where you're going to go, get things moving. Let's get the deal inside the 45 days done, but make sure you understand that 45th day, I'm totally committed to completing the transaction or I'll torpedo it, okay? So, and like I said, if you want to pull some money out, pull it out. You just pay tax on whatever's received. It's not an all or nothing situation. Finally, we've got to have continuity of vesting, and that just means the person or entity that gives us something has to be given something back. And John's going to talk about how their properties are held. And I guess the one last comment, if I'm dealing with DSTs and how you're identifying properties, there's lots of discussion out there on what is the appropriate way to identify let's say a DST, because what you identify the identification means you're giving an unambiguous description and you've got to receive substantially the same thing as what you've identified. John's put the slide up there talking about the 3 different rules. Understand each rule is independent of the others. And so you only have to meet one of those, not all of those rules. And if we look at just let's say the 3 property rule and dovetail in my comments on when you've got access to the funds if you change your mind, we sort of addressed this by saying in our ID form, you're going to identify properties A, B, C, D, whatever it might be, but we've got an additional line in there that says you have the right to only acquire 1, 2, 3, whatever number you want to put in there. And the reason we added that paragraph and added that blank is because if you identify 3 or 4 properties, are you identifying them because you want to buy them all, or are they a primary and fallbacks? And if it's a primary and fallbacks, obviously we just want you to be able to, if you don't spend all the money on that first purchase and you said, okay, I'm identifying 3, I have the right to buy 1. As soon as you purchase that 1, the balance of that money, if we're outside the 45 days, can be released, and then you can go out and spend it on whatever else you want to buy. Otherwise, once again, we're stuck until that day 181. But that's where the issue is. My comment on the DSTs and how you identify them, John, I'm expecting you'll probably cover this a little bit, or at least what your company's thoughts are on it. But there's lots of arguments out there, and my position is not one that's probably widely accepted, but I don't see how you can invalidate it. My position is it's sort of a unified situation. If you pick DST number 3, let's say, with John and Bob, that thing's not something you can pick and choose if that's a multi-asset DST. It's not a situation where they're going to let you go pick properties 2 and 3 out of the 7 that are there. It's an all or nothing situation. Therefore, you don't have the right to choose. You can't go anywhere else. So you're buying it all or you're buying nothing. Therefore, I'm going to consider that DST ID one item, one asset to be identified. There are many people in our industry that are going to say, no, that's 7 properties. And the problem with calling it 7 properties is that now you're dealing with the 200% rule or the 95% rule, which gets very, very difficult. So the other thing when you're identifying a DST, as I said earlier, you're giving an unambiguous description of the property or properties you intend to buy. You've got to receive substantially the same thing. You've got to look at it. Don't identify the entire DST. ID the percentage that you intend to buy. And it might be a percentage and the cash going into it, whatever you want to do, but you've got to narrow it down. It's got to be a specific piece of it. And if you ID'd the whole thing, what I'm going to tell you is you better buy at least 50% of it. My legal people are going to say you better be getting 60% of it or more. So you don't want to ID just that offering, and yet I see those IDs all the time by people, and if you're audited, you're not receiving substantially the same thing. So The only dumb questions anytime we're looking at any of this stuff is the question you don't ask. So ask the questions, take advantage of the resources that the experts on this call, or the people in your life. Ask those questions earlier rather than later. Don't get stung by this stuff. But with that said, I think I've sort of covered my concerns with the exchange. They've been around for a long time, since the 20s. It's we have rule changes every so often. But with respect to my experience and people moving into DSTs, I think that they're a great place to diversify. It's a great place for people. You're going to have lots of people that are, we always joke about the terrible T's: toilets, trash, tenants, turnover. You don't want to deal with that, but think about the world we're in these days, and think about your right of even owning an asset and controlling these assets. And I guess the one thing that I would say is, going forward into these things, especially if we're in times of hardship, what's the economic ability for Cantor Fitzgerald to float assets versus, John and Sue Smith that have a single property and lost their job? What's going to be a more secure investment there and be more stable? So you've got professional management of assets. These people are, pros. They've been doing it a long time. And I'm probably pretty comfortable with the fact if they've been through this stuff before, they'll probably make it. And there's not that many, John, that have been through this stuff before in your space, but you're one of them. So I applaud you guys for that. It's always a pleasure to work with you. So with that said, John, it's you.
Yeah, thank you, David, very much. I mean, for anyone who is in an exchange or about to be in exchange, David is just a wealth of knowledge. I think when you are working with a qualified intermediary, that's someone you're going to want to look at a couple. You're going to do some research just as you would with the CPA. But these are some of the most important people in an exchange. They're going to keep you in line. And you're able to ask the questions, what I can do and what I can't. And sometimes those are the most important ones. What I'm going to focus on very quickly is just introducing the concept of the Delaware Statutory Trust, or DST. The 1031 process is one of the most tax advantage situations for growing wealth. And we have seen this on the books for close to 100 years now, as we talked about. And what we have found is at a certain point, some people don't want to be active managers of real estate. They don't want to deal with the tenants, the toilets, and the trash, like David. And so what this solution is a passive solution. Cantor Fitzgerald, in this case, is going to go out and they're going to acquire a large triple net asset or a large multifamily asset. They're going to manage it for you, and you're going to have a turnkey solution where you get a distribution check each 15th of the month. So I'm going to walk you through that, but I want you to understand what this is. This is a passive way to continue to complete that 1031 process that for some times families have gone through for generations. So the DST, just as it sounds, is a trust set up in the state of Delaware. A company like Cantor Fitzgerald goes out and buys a real estate asset. It can really be any type of asset. They're going to put it into the actual trust. And because of IRS ruling 2004-86, this gives this structure the ability to fulfill 1031 obligations that David just walked through when you're replacing debt and you're replacing equity. So it's a turnkey solution. In the trust goes the asset. The trust also has financing to replace both the debt and the equity. So investors in the DST are not direct owners of the real estate, but instead own an undivided interest in the asset held by the trust. So a great way to have a turnkey solution. Some people use this as a way to access larger, more institutional types of assets. I know at Cantor Fitzgerald, we focus on assets $50 million to $150 million. So larger types of assets. Cantor has been around since 1945, and they own a real estate company called Newmark. And so we are a huge financer through the Freddie, Fannie, not so much the CMBS markets because those have dried up over the past few months here. But definitely have the ability to get institutional financing. We believe the rates that we're going to be able to acquire at are going to be lower than most individuals. These are professionally managed. The way we approach multifamily is that this is an operating business. When you're managing an asset of 300 or 400 units, someone always is moving in, someone's always moving out. So you got to think of these as ongoing operations. So we partner with some of the largest owner managers in the space. The companies in the Bay Area like Hamilton Zants out of San Francisco, they own about 20,000 units and manage about 30,000, and BH Properties out of Iowa. They manage about 80,000 units and 100,000 units. So it's that passive hands-on management that we think makes a lot of sense. You know, clients on the West Coast, especially where cap rates are very yield, and as David mentioned, some of the new laws that are either on the books or about to be on the books, some people feel are not in the favor of landlords. So this is a way to kind of get some of that trapped equity out, use this to obtain a listing from a client, and have the DST be the solution. A passive structure where you're fulfilling your 1031 obligations. Most of the Delaware Statutory Trusts out there have a minimum of about $100,000. So if you're selling a $500 or $1 million piece of real estate, you would have the opportunity to go into 2 or 3 different DSTs if you'd like. So you can diversify not only states, but also sectors. The other thing is, depending on how long an asset has been owned, a lot of time there's no depreciation left. So this is non-recourse debt that the investors are going to take on. So a new depreciation schedule can definitely help come tax season. Just some, I don't want to just talk about the pros and not understand the potential cons or the potential limitations of a DST. DSTs, number one, are illiquid. These are not stocks that can be sold each and every day. So if a client is not willing to really understand that this is probably a 6 to 8 year hold, if this money is earmarked for something else within that time period, probably not a great investment for them. They have to understand that it's passive and it is illiquid. As I mentioned, there's no secondary markets for these types of assets. And in this case, Cantor Fitzgerald is acting in a fiduciary manner about when to sell this asset. What we've seen, and I know Bob and David have seen this, in the last 3 or 4 years, the appreciation has been very strong in the apartment sector. So we have seen a lot of these Delaware statutory trusts go full cycle and return money. So what I can say is, if the markets continue to be, very strong, then it's probably a shorter potential hold. Understanding that we're in a recession now, I think it's important to understand that these are probably 6 to 8 year holds. I'm not going to discuss the 7 deadly sins because these apply to the actual sponsors and the rules that we actually have. Just a few things on DSTs in general, and then we can have Bob say some comments. I think as the baby boomers are getting a little older, as people have different priorities in life, sometimes they don't want to be the landlord. I know my father owned some real estate, and he was in his mid-70s, still trying to be a weekend warrior and trying to, keep up some of these duplexes and triplexes. So I think there just comes a time when you'd rather be with the grandkids, you'd rather be doing something more in your life than dealing with tenants, toilets, and trash. And so that's where the DST investment comes into play. I live in the Bay Area. I work up and down the West Coast. Happy to meet with clients, happy to be a resource for you. And so with that, why don't we have Bob say some words, and then I'm happy to open it up for more Q&A.
Thank you, John. I think between John and David, most of the issues have been covered, but certainly Cantor provides a property selection out there, typically apartments. And if you want information on why apartments, I can send that to you. But the present market, and in a little bit, as Jordan discussed, it's either apartments or industrial today. The other sectors are pretty problematic. So this gives one the ability to get rid of those tenants, toilets, trash, and turnover, and present time, all the regulatory stuff that goes on in Oregon. I mean, they've made it real unfavorable for landlords in lots of cases. So this would be a way to get out of your real estate, go to a marketplace or marketplaces, as John mentioned, where there are multiple opportunities. You could go to Nashville and Dallas, for example, or right now Cantor has a couple of properties in North Chicago and high-end subdivisions. So anything that you want in the way of material, John or I can get it to you. And again, we're kind of open to questions. Since this will be new to a lot of you, maybe we open up the questions and then we'll email contacts out, and I can send information to you on DSTs and the properties that Cantor and others have available today.
Hey, Bob. So just
Yes.
real quick, you and John actually can answer this question. So with Cantor, you guys typically, so a DST, we didn't really talk about. DST could be a single asset. It could be a pool of assets. If it's
Correct.
a pool of assets, I guess, does Cantor typically try to keep that pool in a restricted number of states? And the reason I ask that is, you know, for the people on this call, imagine you buy into a DST with properties in 5 different states. Well, you're filing 5 different tax returns, right? So John, you want to sort of elaborate on that? I think that's sort of important to talk about, you know, whether you're buying a single or multiple, where they're, you know, geographically. But one of the things I love about DSTs is your ability to diversify not only geographically very easily, but with the different food groups, like Bob said, whether it's, you know, hospitality or multifamily or whatever it might be. But anyway.
Yeah, great question. So primarily when we use the DST vehicle, we are only putting one asset in it, especially if it's multifamily. We encourage diversification, but we believe you should create diversification by going into multiple products. With that being said, a number of years ago, we did something called a corporate sale leaseback with Walgreens directly, where we bought 250 Walgreens direct, and we packaged them 15 to 20 Walgreens at a time. And so we have done it in the past, but in the multifamily sector, we prefer not to.
And I think, David, back to your question, some other providers will have multiple properties, but typically they'll keep it in one state so you don't have multiple tax returns, but not always. So it's something to look out for. And I'd certainly always bring it up to an investor so that you know what you're getting yourself or your accountant into. But
yeah, and I think that's the value, obviously, of you know, Nick, you joked about, you know, Bob's been doing this for a while. You know, the idea is, you know, by working with people who have been through these issues, you're hopefully going to, unlike today, they want to tear down all the historical things that are there to remind us of what, you know, where we are and how we are here. You know, you got to learn from history. So right. I just look at, you know, this crash and you think I mean, it's a decade ago, we had the last one, right? So you can obviously apply what happened there to this one and see the differences. I think, Jordan, you made a comment. The thing is so different this time is everybody wants to do stuff. I mean, I don't see people wanting to sit around. They want to make things happen. It's just their ability to make things happen that's crunching things at the moment. But yeah, I mean, you're working with a company. If you're going to look at this DST stuff, you're listening to a guy today that's been in the business for quite a while, you know, both with John and Bob. But, you know, you want to be working with people that know how to make things work, not just in the good times. And, you know, anytime we've got great times, like we had just in the short memory a few months ago, right? We were a little happier just a couple months ago. But you think about all the people, and John, you've got to be sitting there looking at it and think about some of the all these new sponsors jumping in with this frothy market, where you get people jumping in at the top of the market. Well, Anyway.
So David,
No,
I had a real quick. I had a question from someone that wasn't able to attend today that I was speaking with yesterday, and they're invested in a DST that's not with Cantor Fitzgerald, and I won't mention the name of it, but they're haven't been paid in a couple months, and I'm just curious how. I mean, obviously there's certain assets that are just not able to perform right now, hospitality, hotels, retail, depending on, especially if there's non-corporate tenants, and even with corporate tenants, we all saw Starbucks ask for rent reductions across the board. So I would love to hear how Cantor is dealing with that, and what your policies are in the event that there's, regardless of the asset class, whether it's residential or retail or hotel,
yeah.
how you deal with tenants that are in default or just if you have to replace a tenant.
Yeah, great question, especially with what we're seeing right now in the marketplace. One thing David mentioned, and I'll kind of start with this, is that the markets have been so good for so long that anyone who's ever bought a piece of real estate now thinks they can come out and be a DST sponsor, right? I bought a piece of real estate 5 years ago in Northern California. It's doubled in price. This is so easy. And so there are a lot more sponsors in the space. I think there's approximately 40 now. And if you go back to the last recession, there were really 4 or 5 that came out probably stronger. So just that speaks to you need to understand who you're working with. And quite frankly, depending on how long this recession we're in now lasts, you probably will see some DST sponsors, unfortunately, not make it through. So that's kind of the first part. The second part has to do with COVID. And the bottom line is, whether you're talking about a Delaware Statutory Trust, a piece of real estate you own yourself, is if the tenant is not paying, that most of these are quote unquote pass-through entities where the money's going basically into an entity and then it's being paid out. So if there's no money to actually pay, so if you had a single tenant asset and the tenant just said, I'm not going to pay, you don't get a check. And so I think that's where understanding the markets you're in, every type of real estate out there, even within the multifamily, has a different risk reward profile. So you can do a triple net with an investment grade tenant. You can do a 400 unit apartment building in an area that has high income levels. Usually those are going to be able to write it out. What I will say is, knock on wood, at this point, we have about 27 programs in the DST space that have closed and are available, and we haven't had to change the distribution on those yet. Now, that's not to say we're not going to do that, but at this point we haven't, and we have been in some areas that have been very hard hit, like Las Vegas. So it's just one of those things. You want a conservative company that's not going to over project income streams, which is something we see from sponsors out there, meaning, oops, sorry, I jumped. Meaning, why would I pick the 5 or the 6% income yield if I could pick the 7 or 8? Well, that means there's more risk in that actual asset. So I think I answered your question in a roundabout way.
I think one thing that John didn't mention, Nick, is Cantor and the 2 or 3 others he mentioned that survived the last downturn. They're not trying to hit home runs when they buy a property. They're trying to hit a single or double, so they don't plan on striking out. If you want to double your money again this cycle, a DST isn't an option. If you want a conservative investment where the money is going to keep coming in every month, day in, day out, with, as John mentioned, a corporate lease or an apartment house, then a DST might be a good option.
Yeah. So I understand you guys have more conservative underwriting and you're getting debt at preferred rates just because of the scale you're working on and your time in the business. But basically, if you have an asset where, you have 3 retail tenants are all, corporate AAA rated and one of them goes bankrupt, you have to just replace that tenant to get the income stream back up to where it was. Yeah.
Yes.
Correct.
Okay. Yeah. Okay. That makes sense.
I wish it was a different answer that I could, but, just makes sense structurally. If the money's not coming in, then it's not going to go to the investors.
Right.
Well, yeah, and the other thing, it's not coming in. I mean, having some payments that are not maybe being made to the investors is one thing. Having having capital calls is quite another. So,
Sure.
I mean, working with a company that's been doing it and knows what they're doing and has some deep pockets, that's all good. And anyway,
If
just
anyone
Well,
else,
and
if
the
anyone else has any
DST
questions, please use the chat feature, or if you want to unmute yourself and ask a question, please feel free to do that as well.
I
so
guess one
David's
thing that
not,
hasn't, Bob, the one thing that hasn't been really discussed, or Nick too, is I don't, for people out there, don't think of this as all or nothing, like I said, with respect to how much money you're carrying through the exchange, but also look at your facts, what else is out there, and you might pick something up, you might have an overage that you want to throw in this way. So John and Bob, I don't know if you talked about like your, the minimums going in, what's happening there. My comment earlier, and the reason I made the comment about what we call a napkin test, a crosser up in value and equity, and the reason I focused on saying, hey, you don't have to replace debt, is because a lot of times, we'll have people going in and they're going to mix the DST product to fit. You can always add cash to the transaction. Don't look at it and say, gee, I had a 60% loan to value on the property I relinquished, and John's saying, their product's 50% loan to value, so I'm going to have a problem. They're going to have tax. No, you just add the money, pay it down, and that way you take care of it. Or you just change it and you have a little exposure. But I don't want people to go into this thinking, hey, the Cantor product doesn't match the same LTV, loan to value, that my relinquished does. I can't buy it. So you can pick up pieces of it. So you might have given up $1 million property. Your perfect replacement was 800. You got this other money. You don't want to spend it. We'll throw the other two at the DST offer. So look at that stuff, and especially when you're getting closer to that 45 days, as I said earlier, you're either all in or out on that 45th day, and you've just got to sort of look at how much money you want to defer. Understand that this year, 2020 is not starting off, or we're halfway through now. It's not exactly a wonderful year, right, for income. So you might have a situation where you don't even have to do an exchange if you got some things. I mean, the stock market today is looking pretty ugly. Why it got up to where it was is sort of a puzzling question to me. After I understand the drop, but why is it rising so rapidly, and what's going to sustain it? And you think, Nick, what you were talking about, the different classes, and Jordan too, talking about all office, industrial, retail, all that stuff. We don't know where we're headed yet with this stuff. So just look at that. Don't think that it's 1031's not all or nothing. Use the DST to pick stuff up. Don't worry about the debt on the asset. You can always add cash in to get where you need to go, or you've got a little bit of difference there. But those are things that come up repeatedly in my world, and I just wanted to really emphasize those things.
Great,
so
thank you.
back to David's point earlier on capital calls, DSTs do not allow for capital calls. So if there's an issue, it's Cantor's issue or the sponsor's issue, not the client, because they can't make capital calls. David's comment about not all or nothing, maybe you buy a property through city and state and you've got $300,000 left over. Well, that can easily go into a DST. So it's a great place for that leftover money, or as David would call it, boot. And then the other thing that hasn't been discussed is sometimes we've all watched an exchange fall apart because we couldn't get the loan. There was an environmental problem, all these things that happen. These properties are already closed. So there's no issue of, will my exchange close? It's closed. Another advantage to that is if the asset you're selling, you're living off of that income, the money kind of starts coming to you the next month because Cantor already owns it. So if you sell something in July, close it in July, buy a property in July, you're going to get a check from Cantor in August, or direct deposit, of course. But so there are a lot of advantages that way.
That's a great point. All right, well, I appreciate everyone for coming today, and John and Bob and David, thank you guys so much, and Jordan for the market report. Hope you guys found this educational and informative. I certainly learned some new things today, and we'll be sharing this video with everyone. We had quite a few folks that wanted to attend that weren't able to make today's time, so we're going to be following up with them and including every one of the presenters' info. So if you have a question about any of our specialties, you can reach out to us directly, and we can go more into detail on your specific property or your specific goals for your real estate investing plans. So again, I'm Nick Crowder with City and State. Thank you everyone for joining us.
Thank you,
Thank
Nick.
you.
Good job. Thanks, John, David.
See you, everybody. Bye-bye.
Take care.